Definition of accounting, aims, and users. Accounting is the process of identifying, measuring, and communicating financial information about an entity in order to permit informed judgments and decisions by users of the information. Accounting should show in the financial statements what happens in a firm, as if it were a mirror reflecting the true and fair view of the firm's economic reality. Accounting is also the language of business used to communicate economic information to different company stakeholders in order for them to make useful decisions. These groups are managers, shareholders, employees, creditors, clients, auditors, government, press, and potential investors, among others.
Users of financial accounting are external, and the kinds of documents that they use are financial statements. The rules are in a standard way, and they are public and compulsory for all firms, while management accounting has internal users. The kinds of documents are management report, budget, cost reports, reports of sales, for example. The rules are particularly for each business. They are private and they are also voluntary.
The accounting conceptual framework is defined as the rules of the accounting game. It is the why, who, what, and how of financial and accounting reporting. The aim of the framework is to provide information, a true and fair view of the company's financial position and changes in the financial position useful for economic decision making. It will influence asset definition, implicit interest, leasing, sale and purchase agreements, etc. The accounting framework in Europe is based on the International Accounting Standards and the International Financial Reporting Standards issued by the International Accounting Standard Board, with the aim of bringing transparency and efficiency in markets in the European Union. In Spain, the Spanish accounting framework goes in line with this philosophy. Its structure is divided into 6 parts as follows.
The statements are the product of financial accounting. They must give the true and fair view of financial position, financial performance, and cash flows of an entity, and they show the real situation of the company. There are 2 documents that are mandatory for listed and large companies, such as the statement of changes in equity and the statement of cash flows, but there are also 3 documents that are compulsory for all firms, such as the balance sheet or a statement of financial position at the end of the period, the income statement or a statement with profits and losses for the period, and finally the explanatory notes that comprising a summary of significant accounting policies and another further information.
The information included in the financial statements must have the following qualitative characteristics, which are relevance, reliability, comparability, and integrity, consistency, and clarity.
Accounting principles. Going concern. The assumption that ordinarily an entity persists indefinitely. Accrual basis. Companies have to recognize the impact of transactions in the financial statements for a period when revenues and expenses occur. Uniformity. Once an accounting criterion is adopted by a company, it has to be maintained over time. Prudence or faithfulness. Profits should be registered in the period in which they have been obtained, but losses must be registered when they are expected or known. Offsetting. The company cannot offset information in order to avoid omissions. Materiality. Information is material. If omission or misstatement could influence the user's economic decisions based on the financial statements.
Financial statement elements. Grouped in the firm's financial situation, we find the following: assets, which are company's rights, goods, and economic resources; liabilities, which are obligations to pay; and net equity, being the owner's wealth. These elements belong to the firm's balance sheet. On the other side, reflecting the firm's economic situation, we find revenues, or increases in equity, and expenses, also called decreases in equity. Revenues and expenses belong in the income statement and statement of changes in equity. Finally, it is essential to highlight the accounting basic equation. Assets must be equal to the sum of liabilities and equity.
The 5th part of the Spanish accounting framework is the registration criteria. Accounting registration is the process of identifying and registering the economic transactions that have a direct impact in the equity of the company. Registration criteria is the process of taking the different entries into the financial statements. And accounting valuation is the process of assigning the monetary value to the different items included in the financial statement.
But how do we turn business reality into business language? Valuation criteria is the channel through which to translate this information, that is, to assign the monetary value to the assets or liabilities with regard to the applicable accounting framework. Firstly, one of the most important valuation criteria, although not the most reliable throughout time, is the historical cost, which is the original cost of an asset. Having acquired this building in 2012 for a sum of $1 million, its historical cost will be $1 million, and it will never change even 8 years later. Moreover, we find manufacturing costs, which are the costs incurred during the production of an item. These include raw material, labor, and overhead. Here we see an example. To produce this car, the car company has spent $3,750 on raw materials, $250 on labor, and $150 on overhead, which leaves us with a total of $4,150 of manufacturing costs. Then there are sale expenses, which are the costs incurred by the sales department. Here we see another example. To market this car, we have spent $250 on advertisement, $250 on commission, and $1,500 on fees, which leaves us with a total of $2,000 in sale expenses. Finally, I present to you the book value, which subtracts any depreciation an asset or liability may have suffered. Imagine this telephone. In 1985, it may have been a $120 blast, but in 2020, its value is $25 due to depreciation over time.
When talking about accounting regulation in Spain, it's important to take into account that we are in the European Union. So, first, the Spanish accounting has to abide to the European standards, and then to the national ones. The Spanish accounting regulation is controlled by the Instituto de Contabilidad y Autoridad de Cuentas. It's important to note that in Spain, the main document for financial accounting is the Spanish General Accounting Plan. The structure of this document is first, accounting framework, second, recognition and measurement standards, third, annual accounts, fourth, chart of accounts, and fifth, definition of and accounting entries. The first three parts are compulsory and the other two are voluntary.
Social responsibility and corporate ethics. Accounting and auditing are professions of public interest. Auditors have a professional obligation to truthfully report their findings to the public and must act with integrity and be independent of management's influence. For this, auditors and also accountants must abide by a code of professional conduct, normally an ethical code. Some real cases of accounting frauds are those of Enron, Parmalat, Gowex, Pescanova, and Bankia.